In this lesson, I would like to explain a topic that tells how much money do you need to start forex trading. Inside this article, which I have written here on the Get No Trading website, you will have much more details, which I will cover here in current video lesson. On the right side, I have a chart for the Euro USD on a 1-minute time frame, so I can show you trading examples why I'm speaking about this topic. How much is needed? Well, it depends also how much you can invest, what are your expectations, and what is possible for you as a trader. Are you patient, disciplined, or you have a bigger expectations based on the trading outcomes? Would you like to earn a lot of money very fast, or you have enough time that you can allow the trade, that the trade can, after you open, it can go up and down, jumping around until it reaches your certain target. Now, is it possible to start trading with $100 on a forex market? Yes, it is. Is it very good to start with $100 as a starting capital? Well, it's not, because there will be some obstacles that you will encounter while you are trading with a small trading account, which eventually could probably lead you to over trading, and that means opening too much trade at the same time, or over leveraging, oversizing, which means opening a trade with a large lot size. And the lot size defines how much each pip will be valued. And what is the pip? The pip is the smallest price change when the price goes up or down. So when the price goes, for example, up for 10 pips, for example, like this amount, this change of 10 pips, you can see in the middle I have number 10, that means 10 pips. It can be valued $0.1, it can be valued $1, it can be valued $10, $100. Everything depends on the lot size. And the lot size is something that you define here. When you click here, a new order, a new window opens, and here you define what is the volume. When it says it is 1, that means 1 pip, which is, I have shown you, which is, for example, 10 pips difference up or down. That means up or down. This means this will be equal to $10. But if you increase this one, for example, to number of 2, this means that this value of 10 pips or of 1 pip, it will be valued $20. So this is also what that means. Now, if you have $100 as a starting capital, you will start maybe increasing this lot size just to earn more money. But if you have $100 on your trading account, you will not be able to open this one standard lot, because the broker will not allow you to open such a large lot size. But you will eventually start with 100 times less, with 0.01, which means when the price change by 1 pip, it will be equal to $0.1. Now, if you have started with $100 and you earn $0.1 when the price changed by 1 pip, this could lead that this will be too slow and you will not be patient to earn a lot of money. Now, here it is a question: should you start with $100 or $1,000? $10,000? I will explain in this topic. Well, being undercapitalized is one of the most common problems traders face when starting forex. And why is that? Because I have just explained, when the price change with this number of pips, that means 1 pip, you will earn $0.1. And this is something that a trader will not be satisfied with such small amount of money earned per pip. He will try to open more trades, or he will try to increase this lot size. So the pip, which is the smallest price change, will be valued much more. So he will try to earn more money very quickly, which at the end ultimately leads to completely wiping your trading account balance. So the starting $100 will be wiped completely very quickly if you have started trading with a large lot size or over trading. That means opening more trades than you can sustain. Now, there are some brokers that will allow you to open a trading account with $10, $50 or $100, which is okay, but it is not advisable to start with such small amount of money. First of all, you need to start trading on the demo account, where you can open a demo account with $100, $1,000, $10,000, $1 million. It depends on you. It is virtual money which you can lose and then restart again. Now, Have in mind that each person is different, and some scenario will fit better to one person where to another person will not. Some of the traders are patient and disciplined, they can follow the trading rules, even the earnings per trade is very small. Well, here is the topics I will cover. First of all, starting capital, which requires a risk management, which means a risk to reward ratio is also very important. Then you have a starting capital in Forex, what is the PIP, which I have just explained, how the PIP is valued. Then you have a scenario, 1, 2, 3, depending on the amount of your starting capital. Then it is recommended starting capital and the problems with a small starting capital in Forex. We will see that small gains are frustrating, a small balance limits you, and your cost per trade is higher when you have a small balance. Starting capital in Forex to open an account, it will be also covered here. Now, what is the risk management, the risk to reward ratio? It will be much better that I move right here, where it will be possible to explain a little bit more detail. Now, the risk management in trading, that means you need to prevent your loss whenever you open a trade. For example, if I open this trade here and I click, for example, sell by the market. Sell by the market means when I open the trade, I am expecting that the price will go down, not go up. If it goes down, reaches, for example, this level here, I will make money. But if the price goes against me, I will lose money. So I will click sell by the market. And here it is. The trade is open and I will put a stop loss and the take profit. A stop loss is the level where I define the acceptable risk per this trade, and I will change here to 5 pips just for this example. Okay, and here it is. So I can see here, this is the stop loss, it is called SL. Stop loss will be here, that will be equal to $0.5. Then my take profit will be is also $0.5. So I have defined that I would like to lose $0.5 if the price goes against me, and that means if the price goes up. But if the price goes down, I will make money $0.5. The risk tells you how much money can you lose per trade, and this means $0.5 is how much percentage of 8,000. It's very, very low. So if I would like to limit myself 1 to 2% of my account capital, which is 8,000, so 1% would be around $80. So I could open a trade where I could define that this stop loss could be $80. So currently it is 0.5, so I can increase this by 100 times, so it will be very close to $50. So if I open new order and I increase this 100 times, which will be equal to 1, and I click sell by the market, then I put stop loss and the take profit at the same level. Here it is. I will close the first order so I do not confuse you. You can see that currently I have minus $50. It is close to 1%, but for the example, it is right here. So I have limited my risk per this trade. So if the price goes against me, it will close this order with minus $50, which will be less than 1% of my trading account. This is one of the rules, which is called risk management, where the risk reward ratio is defined. So for example, in this case, I have $50 as a loss and the risk is 1. So if I have a risk of 1, my reward should be at least 2 or 3. And that means how much times I should have take profit equal to compared to the loss. So if my loss is $50, so I should have at least $100 of profit or 150, which will be 2 or 3 times more than the loss. So in my case, I have a profit equal to $50, which means a risk to reward ratio is 1 to 1. So I need to increase this one here at least to 132. For example, here it is currently at 154. So currently I have a risk to reward ratio 1 against 3. So that means I'm losing $50, but if I make money, that means my trade closes with a profit, I will earn 150, which is 3 times more than the loss. So this is the risk to reward ratio. At least I have 1 against 2. That means in this case I should have a profit very close to $100, which means I am risking $50, but in case of profit I will make $100. This is the risk to reward ratio, And if you have 1 again as 3, that means for 1% of risk, you will have 3% of profit. So this is one of the case that you should also follow. Very important risk management. Always protect your trading account and always have a stop loss, which should not be more than 1% if possible. Now, starting capital, pip and lot matters. This is something I have already explained at the beginning. When you have 1 pip, which is the number 10 here, can be valued to $10, $1, $0.1. Everything depends and it is defined by this volume, which is also called lot size. Now, here it is an example. If you trade Euro USD trading pair and the price change from 1.2965 to 1.2966, the price is changed by 1 pip. You can see the number in the last digit on the 4th place, so it is 1 pip. So if you calculate this one, here it is the standard lot size, and the standard lot size is this one where the volume is equal to 1. Micro lot size is 0.01 and the mini lot size would be 0.1. 0.1. Here it is, you can see that here. And the value of 1 pip is equal to $10, $1 or 0.1. Now, here it is an example. If you have invested $1,000 and you open a trade with micro lot, which is here, where 1 pip is equal to $0.1, you will need to define what is stop loss level. So stop loss level is the price where you close the trade. If you define that you will risk 1% of your starting capital in Forex Tank, that will be equal to $10, which is from $1,000. Now, to get from $0.1 to $10, you need to have 100 pips change. So if you have an example here with these prices, you can see that this price should change from 1.2965 to 1.2865, which will be equal 100 pips. Now, here are the scenarios in Forex. Here it is, scenario 1, where you have a starting capital of $100. Now, if you risk 1%, which will be equal to $1, the price must change by 10 pips, because 10 pips multiplied with 0.1 will give you $1. You can see that you are very limited. Why? Because if you have 10 pips change, this is very fast that the price can change in a minute. So for example, if I take 1 hour time frame, you can see how much of 1 hour, for example, here it is, 7 pips the price has changed in 1 hour. But take a look here, how much the price has changed here, 40 pips. So 10 pips will be very easy to reach. So you will not allow the price to jump around, because very quickly you will reach 10 pips, which will eventually lead to closing the trade with a loss. So you need to have more space to allow for the price change. So you can see that you are very limited on $100 starting capital if you are risking 1%. Now here it is, scenario number 2. If you have $500 as a starting capital and you are risking 1%, that will lead you to $5 of loss. Now, if you would like to lose $5 with 1 micro lot, which is where 1 pip is equal to 0.1, you will need to lose 50 pips. That means much more, because you will have 50 pips of free space. Now, if I take a look here, in 1 hour, the price has changed 20 pips, then it is around here 30 pips. So you can see that you are allowing the price to jump around, and there is a possibility that the price goes in your favor. So $500 will allow you much more space to jump around compared to $100. For example, this is 10 pips on $100. This is something that the price can jump. But if you have $50, this is the value how the price can change. You can see much more free space. That is the difference between $100 starting capital and $500 starting capital. Now, scenario 3 is if you have $5,000, you will allow the price to move around for $50. And that means if you have a micro lot, that means 500 pips. And that is a lot. That is a lot, because if we take a look here, the $500 is more than this I can show you here. So there is a possibility for the price to jump around, and you have a free space that the price can jump, not closing with the stop loss very quickly. Now, this is very important information. So what should be a starting capital and you can see how it is connected with this lot size, which is the volume. Now, recommended starting capital in Forex. Now, if you take a look here in the trading scenarios, you can see what is the difference and also what is good idea to start trading. Will you allow the price to jump around, for example, like this, or you will allow it to jump like this? Now you can see in the chart how the price changed. The price goes up, but it jumps around. So you need to have to pay attention on this to allow the price to have a free space so it doesn't activate a stop loss very quickly. Now it depends also on the trading pair. You can see here, if you have a highly volatile trading pair, you will see that even more they are jumping around. Now if I have GBP USD here on the trading, you will see how much they are jumping around. You can see 100 pips easily, 100 pips easily. It is here. If I take a look here, it is, we can see here 300 pips, it jumps around. So you can see almost 3 times more than the Euro USD I have shown you just slightly before that. Now, one of the most important things you need to remember that you should invest, if possible, enough money where each trade will give you enough profit, which will where you will be satisfied. And that means if you open the trade here, you should not be unsatisfied. What that means, if you are earning, for example, $6, $13, this should not be very bad feeling for you. What means that if you are not earning enough money, you will not be satisfied, which is also normal. So if you are able to invest more money, so you are satisfied when you open the trade, you will much more likely to leave the trade open, and you will not open a new trade with higher lot size, where it means that you will risk even more. Demo test is very important. On the demo account, you can see that here with the IC markets, I have opened a demo account with currently $8,000. So you can start trading and practicing without worries. So you can start making your trading strategy, trading rules, how to enter the trade and when to exit the trade. Now here are the problems with a small trading capital, which means $100, $500 or $1,000. Small gains are frustrating. So here it is as an example. When you earn 1 to 3% on $100, that means you are earning $1 or $3. But if you have $10,000 as a starting capital, 1% or 3% will give you $100 or $300. Now you can see what is the difference. It can be frustrating when you're earning only $1, $3 per day compared to $100 or $300. Now you can see what kind of problems and trader can experience if the starting capital is too small. Small balance limits you. This is something I have already explained. And that means if you have a small starting capital, if you are only risking 10 pips, for example, like this, you are very limited because the price can jump around in a day to wipe your account or the trade that you have open. But if you have a larger trading account where you can risk 50%, you can see how this jumps around and you have much more space for the trade. Then you have a cost per trade is high when you have a smaller balance. The cost per trade is defined by the spread. Now if I go here to 1 minute time frame, let me check the properties, common, show ask line. Okay, let me check another one. Okay, on a 1 minute time frame. Now here it is. You can see these two prices. One is gray, the second one is red. The difference between these two prices is called the spread. So if you open the trade, for example, let's open new trade, sell by the market. You can see that currently I have immediately loss of -7. So that means I have commissioned by the broker with $7, which means immediately when I open the trade, I am in a minus. So if you have $100 as a starting capital and you open the trade like this, $7 is 7%, which will completely cover the possible loss on your trading, on your trade that you have currently open. But the trade that you will open with one lot size, for example, if I open with a mini lot, you can see that here, the loss will be $0.07, but you are starting with a loss. So if you have stop loss set to $1, you will much more quickly reach that $1 of loss because you need to add 0.07 commission that the broker has took over from you when you open the trade. Now here it is. What is also important, Each broker defines what is the minimum capital that you can open, or that you can open the trading account. Some of them are saying that you should invest at least $100 to start the trading, to open the trading account, so pay attention to this. But some of them allow you to open the trading account with $10. It is possible to start trading. So if you would like to check that, start with a small trading capital just to get the feeling how it is to trade with a live account with the real money. Then start with a very small amount if you lose that, so you do not have any problems with that. So the conclusion is, do you have a proper starting capital? If it is possible, that will be enough, that it will allow you to have a trade open so you can jump around. Always use the risk management, and that means put stop loss that on each trade that should not be more 1 to 2% of your starting capital. Then pay attention so you're not frustrated when you have a small gains. That means have enough of starting capital so you can open a trade with a larger lot size, so where 1 pip can be equal to $1 instead of $0.1. So this is all for this video lesson. I hope this has shed some light on this topic. How much money do you need to start forex trading? There are some limits, but there are some things that you should pay attention to when start trading with a small amount of money. Larger capital will allow you to earn more per trade, which eventually can be satisfying, instead compare with a small trading account where you'll be very limited. So if you have any questions, feel free to leave a comment. I will try to answer as soon as possible. If you like this video, click the like button and subscribe. Share with others if you think it will be helpful. See you next time, and happy trading.